I mean, we could break through the 3%, but I think it's hard for the market to sustain long-end Treasury yields being above 3% meaningfully for a sustained period of time, unless we get a further pickup in inflation and we get signals in terms of the Fed. I think one of the points that's happening at the moment is that the market's really only pricing in another 2 to 3 rate hikes. It's not really pricing in what the Fed is saying it's going to do. It's saying we don't actually believe you're going to get there. And so it's hard, I think, for long-end treasuries to really sort of push out of that. And then on the other side, you've also still got very low yields, of course, in Japan and in Germany.
On the flip side, I guess, if I want to follow that logic, in case we get a very high print today, let's say we get a 5%, sure. The market will probably be quick to price in a faster rate hiking cycle coming out of the Fed. As you say, it's underestimating what's priced in versus the dots and the guidance that they've given. If the market prices in a more hawkish Fed, another way of thinking about it is it actually could be quite constructive for the 10-year Treasury, because we're every time the market perceives to be the Fed to be more hawkish, the curve flattens. And potentially we could see a situation whereby a very strong number is actually bullish for long-end fixed income.
I mean, possibly. I do think that there's a couple of things. First of all, that we could actually be at the point of kind of peak growth for the US. I think it is going to be a very strong number. I don't think President Trump and his administration would be touting this number unless they were pretty confident it was going to be very high. And then I think what's been interesting is that with first half of this year, we've had this divergence, as you alluded to, between the US growth leadership and the rest of the world. So suddenly we went from a synchronized global growth story, good for risk assets and emerging markets.
I want to pick up on that. I mean, did you expect growth in Europe to fall as far behind the US as it has so far this year?
That wasn't our expectation, but I think the market also has got too pessimistic about the outlook for growth, particularly in the second half. And as I say, I think the first half has been very strong for the US. Part of that is simply that they've had big spending increases as well as the tax cuts coming out of the federal government. I think more encouragingly, we are seeing some pickup in capex as well. But I think if we start getting a sort of bit of a recoupling between the rest of the world and the US, maybe this is peak moment for the US growth outlook, then I think that has implications not only for rates, but also for the dollar. I mean, what's powered the dollar stronger has actually been that divergence. I think if we get some recoupling, that's going to be sort of a headwind for the dollar, I think positive for emerging markets.
And interestingly, in this environment, we've actually seen credit perform quite well. We've snapped back quite a lot in the last month. Also, emerging market credit has begun to snap back a little bit as well. What is your take on emerging market credit from here, given the potential move we could see in the dollar?
Well, we've been adding to emerging market, hard currency dollar credit, particularly in the sovereign space, in our multi-asset credit strategies, because we felt that after the sell-off that you saw in April, May, June, that they were actually offering good value. There was quite a lot of value to be had, particularly given that we don't think that we are facing some sort of systemic problem or crisis within emerging markets. A stronger dollar definitely is a headwind. I think we're a little bit more neutral now. I'm certainly more neutral on the dollar going out over the next 6 months or so.
One final question, if you don't mind. What impact do you expect from this seeming warming of relationships between the European Commission and the US after that meeting this week, if any?
I think the impact is that that's a ceasefire, which I think is going to prove to be quite fragile because there's a lot of elements on both sides. On the European side, agriculture. I think if I was sitting in Beijing, I'd be pretty worried, because it sounded like the US and Europe, when they talk about reform of the WTO, really they're talking about making it less China friendly. I'd be quite worried if I was Beijing. I think we're going to get potentially more tariffs imposed on China come the end of the month or early September.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.